Hey, this is Tom Nash, and in this video, I'm going to give you 7 reasons why this is the perfect time to buy Palantir stock. Now, I know what you're going to say. Palantir ran up 140% year to date, and you never want to buy into a spike. That's the conventional wisdom. But in case of Palantir, the thing's a little bit different because this company has the perfect setup to outperform everything in your portfolio for the next 5 years. Now, the reason I want to make this video is because I want to explain to you the right way to do it. What I don't want people to do is pile into Palantir right now at the current price level, going YOLO, basically going their kids' fund money and putting it right into Palantir. That's not the purpose of this video. I have a different system in mind, which I'll share with you at the end of this video, because no matter what I'm saying in this video, the fact remains that this stock is overhyped, it's overbought, and the current price level is a little bit too high than what it should be. Given that, and given the fact that you know this is a good company you want to own for the next 5 years, what do? Well, wait till the end of the video and I'll explain how to buy into Palantir right now despite the hype and still keep your average cost very, very low. There is a way to do it, trust me, not blowing smoke up your bum. Now, before we get to that point, first of all, I have to give a huge shout out to today's sponsor, Tendies. Tendies is our sponsor for today. Tendies has a free platform for you to use, no premiums, no payments, free information about the market, microanalysis, and an options flow and an options calculator, all for free, and you can actually connect it to your brokerage and get even more customized information. Go to Tendies right now. Tell them Tom sent you. There's a link below. It is absolutely free. Check it out. Let's make a case of why Palantir is going to outperform mostly everything you have in your portfolio, I think, for the next 5 years. And then I'm going to show you what's my system of buying into the stock without emotions, without panic, without FOMO, and actually keeping my cost base very, very low. So the first thing I want to talk about as far as Palantir goes is the thing that doesn't get discussed often on mainstream media, which is the US client acceleration. Now, look at this way. In 2021, Palantir had 20 clients on US commercial. Right now, they have 155 clients. So as far as US commercial clients, Palantir grew its customer base by 8 times over the course of the last 2 years. I don't know a lot of companies that can say that they've 8x their customer base over 2 years, especially given the craziness we've seen for the past 2 years, given the bad macro we had. Still, these guys have done an 8x on the client base. Now, another thing I want to talk about is the Q over Q, quarter over quarter, average spend per commercial client. Palantir commercial clients have spent 28% more this quarter than they did in the previous quarter. How many companies can give you 28% growth in commercial spend like that? Not a lot of companies. Palantir commercial is literally on fire. Now, the other thing I want to talk about is the fact that Palantir had 2 consecutive quarters of positive GAAP. Generally accepted accounting principles profitability for 2 quarters in a row. That is something that people didn't believe Palantir can do even for 1 quarter, but we just had 2 consecutive quarters and a guidance from the company basically saying, hey, the rest of this year, the next 3 quarters will also be positive. We're going to have a full year of GAAP profitability in 2023. Now, that's awesome because it shows track record, it shows trajectory, but mostly it will fix the Achilles heel of Palantir. One of the biggest weaknesses of Palantir so far has been the fact that institutional investors are not excited about this company for a multitude of reasons. One being no GAAP profitability. Once we have 4 quarters of GAAP profitability, the institutional shareholding percentage of this company is going to go through the roof. Currently, the institutional shareholding percentage of Palantir is around the mid-30s, which is quite low. Now, some companies can pull it off like a Tesla, but for most companies, a low shareholding percentage from institutional investors shows lack of stability, shows volatility, and basically it scares off investors and it creates a volatile stock. Now, of course, Tesla can pull it off, maybe Palantir can't, but we would not mind seeing that percentage go to 40, 50, maybe even 60%, like in the case of most good companies. And if that happens, the rest is history. Now, another thing you have to understand that if we do get 4 quarters, consecutive quarters of GAAP profitability, this means Palantir would be eligible for S&P 500 inclusion, which is a massive milestone. Remember what happened to Tesla. When Tesla got included in the S&P 500, it went through the roof. Not saying it's going to happen with Palantir, but it's going to be a major positive catalyst we can't ignore. Now, if you go back and you look at the business of Palantir, look, you may say that you don't fully understand what they do, and I totally get it. But look at the numbers. And there's one thing I know, nobody will pay $51 million per year for 17 years for vaporware, for stuff that don't work. So if guys are paying $51 million a year over the course of the last 17 years, that means their stuff works. And not only that, they have a net dollar retention which is above 100, and Their average spend for the top 20 clients is up 14%. Last year it was 44 million, currently they're at 51 million. So they're not only growing revenue by getting new clients, which is important, but you can clearly see that their existing clients are spending more every single year, which is a sign of a good business. It's a sign of stability. And that is just the beginning of a trend. But look, I know what you're going to say right now. If you look at the PE, at least forward PE for Palantir, it's above 60, which is very, very high. Few companies justify that. Tesla, sure. Nvidia, probably. But Palantir, look, I know it ain't cheap, but there's a solution to that. You don't have to buy it at the top and keep the price levels high. You don't have to guess. You don't have to time the market. I'm going to explain. This isn't a cheap stock by any means, by any stretch of the imagination. But at 60 PE, it's reasonably priced, especially if you're going to use my system to dollar cost average and get a lower price base. So yeah, 60 PE isn't cheap, but if you use the right system, you can lower your cost basis and get it at effectively much, much lower than that. I'll show you in a second how. Now look, another thing I want to show you here is the revenue of the company. So Palantir did 446 in Q1 of last year. We're talking about millions. This quarter, they did 525 million. So Q1 head-to-head, 18% up, which you should have known this by now. But there's one thing they're not telling you. Look under the hood. While the growth of revenues was 18% in a horrible macro year, the growth of operating expenses was only 5%. So if this is a company that's able to grow 18% of revenues in a year with only spending 5% more on operating expenses, this means that gap is going to widen every year. The profitability is only going to get better. It's another sign that I'm dumbfounded we don't get to hear about in mainstream media. Now, obviously, you know the fact that this company is sitting on $3 billion of cash. It has no debt, which means it has massive amounts of opportunities, no interest expenses, no sensitivity or exposure to interest rates and stuff like that. And it has $1 billion of remaining obligations, which means $1 billion of revenue sitting in the bank, which they will use for the next 2 years, and it's going to spike up the revenue growth even more. Now, another thing I want to talk about here is one of the, battering rams that people use against Palantir, which is stock-based compensation. The company is diluting shareholders. Yes, it has a higher stock-based compensation than most companies, and for good reasons, which I've explained in previous videos. Now, look, at the end of the day, look at the trend. Stock-based compensation this year went down by 23%. 23% down, and it keeps getting down every single quarter for the past year. Look at the comparison to the revenues. The stock-based compensation of Palantir as a percentage of their revenues in 2021 was 57%, which is insane. I agree. But last year, it was 33%. This year, it's 22%. And of course, that number can come up, but it's not going to go back to the 57% level. That happened because of many reasons, like going DPO, like hiring a new sales force, etc., etc. All these excuses don't matter because this problem is no longer a thing. Currently, Palantir isn't unusual. It has the same spend on stock-based compensation like any other company out there, at least in the growth tech space. Now look, one thing I want to mention, people talk about, government business, etc., etc. Look, the government business of Palantir is not going to make them into a $1 trillion company. It's not, but it's a life vest. It's there, it's sticky, it's not going anywhere. If things get bad, and if macro gets bad, the government business of Palantir is going to keep it afloat while other companies will struggle. So this company is not only built for good times, which of course it will thrive in, it actually has downside protection. By having 40, 50, 60% of its business in government, that's going to protect them from bad times. So you're not only getting the upside, you're getting a lot of risk protection here. And now to the $1 trillion question. How do you buy this stock without the FOMO, without the emotions, without all the craziness? Well, look, obviously you cannot buy this stock right now by going YOLO into the current share price. That's a bad idea. You play stupid games, you win stupid prizes. So what you do is you use our dollar cost average system. You figure out what is the threshold amount for this company. So if the 52-week high for Palantir is $17.16, you take out 10% below that, which means $15.40. Anytime the stock is below $15.40, you double down and you spend twice than your monthly allocation for Palantir, which you should have had by now. Watch the previous videos. So anytime it goes up above 15.4, you spend half that. And you dollar cost average more when it goes below the threshold amount, you dollar cost average less when it goes above. By the time the dust settles in a couple of years, whatever happens, your cost basis, because you double down more when the stock was down, is going to be way closer to the bottom than to the top. And it will require discipline, it will require patience, and it's going to take a few years. But you will get to the right spot without the FOMO, without the hype, without anxiety, without all this nonsense. Now, if you want to learn more about the system, I'm happy to teach you. Join our Patreon, patreon.com/Tom Nash. This is literally what we teach every day on our Patreon, on our Discord. We have 4,600 members, and we just launched Tom's Academy, a brand new educational system, which I highly advise you check out. We have like 5 spots left. Check it out. The description is below. Would love to see you there. You'll get a weekly Zoom call, lessons, evaluations, all the good stuff. Absolutely mind-blowing stuff. Would love to see you there. See you in the next video.